GMGM. Today is Friday, May 30th. It's the first day of the rest of our lives, and we hope for your sake it's your best one yet. We're very excited because we've got on Sid Powell from Maple Finance. So we've seen him all over lately. We got a chance to actually meet him in person a couple weeks ago, and since then, I think on a Congress, on all sorts of like huge podcasts, and now coming down to join us on Leviathan News. So just before we get started, take a look at that QR code in the upper left-hand corner. That's brought to you by our sponsors for this week, which is AIOZ, who are redefining DEPIN. If you for some reason dislike them, we're also having an auction live on our website, leviathannews.xyz, to replace the QR code this week. So pop on there and bid. It's going for, I think, 7,000 squid right now. So very intense bidding. We will see how it shakes out in about half an hour when it closes. Maybe we'll even shout out on stream if we got something, but probably not, because we're going to be so engrossed in this conversation. We've heard a lot of amazing things about Maple Finance from like institutional players, from hardcore degens, and we were saying, like, why is everyone going so crazy about Maple Finance? And then we looked at this chart, and this chart from DeFi Llama tells the entire story to us. That's like better than the hockey stick growth that you're looking to see. It's like as like exponentially up and to the right as possible. So we're amazed, as mentioned, that like Sid is taking some time to like actually hang out with us and talk out instead of just like sitting and like swimming through your money bin. Sid, what's going on?
I wish I had a money bin, but no. Very happy to be here, Garrett. It's good to catch up. It's been a few weeks since we saw each other in person
It feels like
at
a
that dinner.
lifetime.
So yeah, I know,
Lifetime
I
in DeFi,
know.
right?
It's yeah. I often say that it feels like time in crypto kind of moves like dog years. You know, every seven weeks for every 1 week, 7 years for every 1 year. But no. Really happy to be here.
Yeah, exactly. I mean, I'm only 22 years old, but I look 65 because of
Tell you what, I had a lot less grays before I was in crypto.
no, so like looking at that DeFi Llama chart, like I could tell also
Mm,
like you've had an incredibly storied history because you had this kind of like what looked to me like quite. I know you launched in 2019, and then it looks like around the SBF like crash, like
mhm,
TVL up, TVL back down, and then you launched V2. It looks like into the bear market,
mhm.
and it's sort of more lately taken off. But I'd like to hear like the entire like history of Maple. I know you only have so much time though, so just like what's the origin story, and like what were the like inefficiencies in the traditional debt capital markets that were inspiring you to like move these things on chain?
Yeah, there's definitely a lot there. I'll try and leave out the boring parts. So I used to work in banking. So I was in an area called securitization. So it's a part of debt capital markets. But basically, what it meant was I would help lending companies to borrow, and they would borrow from banks, from insurance companies, from other investors, and asset managers. But basically, they would take a really large amount of money, break it into smaller amounts of money, and then give loans to their customers. And so I was doing that for a few years, and then I kind of wanted to move to a more uh, startup-y type environment, and so I went to a smaller commercial lender, and that was where I met my co-founder, Joe. And so that was we were in Australia working at this smaller lender, and that was kind of where we had the original idea for Maple, and it came out of the fact that that company was kind of too small to go and tap debt capital markets. So it was too small to kind of raise really large amounts from investors. And we started thinking about, was there a way to just issue bonds using a blockchain? And so the idea that kind of really took my fancy was that you could effectively have every dollar be a kind of separate class of bond, because it would be super easy to program that using smart contracts. It's not actually the case that that's extremely easy to program using smart contracts, but that was kind of at least the sort of the Trojan horse that got us interested. And that was 2018, early 2019. We started writing a white paper, and then we just early on we just put in our own savings into the concept for Maple, and we had to kind of go in a few wrong directions first. So we were doing early on, we were doing kind of anonymous loans to random people, um, through smart contracts that we had built using our own savings, and then hoping that these people would pay us back. And miraculously, these anonymous Good Samaritans did pay us back, so we didn't lose any money doing that. But we thought, geez, this is hard. We should probably just stick to doing institutional lending, which is kind of what I understood from banking, and what we sort of together understood from working at that company. And so we refocused Maple. We got very lucky, actually, that one, COVID happened, and so it was then possible for a couple of guys in Australia to raise capital from, American and global VCs, whereas that would have been, an extremely difficult task. Um, had COVID not happened and everybody switched to just doing Zoom meetings, and then DeFi summer happened. So Robert Leshner at Compound released the comp token, kicked everything off, and then suddenly we were able to to put together this concept of um, institutional lending on chain, done with smart contracts, and with a token kind of underlying and knitting everything together. And that kicked off this kind of amazing sort of 2-year journey from early 2021 when we first launched the protocol and the token, to right up into late 2022 when FTX happened. And that kind of bookends really the first phase of Maple, or kind of part one of Maple's story. And during that time, we were doing lending to market makers. We hit almost $1 billion of TVL, and then the the space kind of imploded, as everyone's aware. So you had the three largest lenders are all no longer here today. So Genesis, Celsius, BlockFi, um, and then obviously there are a number of large names that like FTX, 3AC, that are also no longer here today. But what that did was it forced us to revisit, what is Maple good at? What do we have a competitive advantage in? And what is nobody else doing that we can people would pay us for? And that's how I kind of think about competitive strategy today, is we will try and do things that we have a competitive edge in, and that nobody else is doing, or is underserved by the market. And so in that in between period, we tried doing tokenized T bills, and we found that it was a hugely competitive space. There was 15 other people doing that, and it was a race to the bottom on fees and margins. But we saw that nobody was doing over collateralized lending. The biggest names were gone. Every smart person had written off lending on chain, and thought it was a fool's errand. And so late 2023, we changed the business model so that Maple would be the originating team and the underwriter, instead of a platform for others to do so. And we started doing over collateralized lending, and it was a grind. We got the first couple of loans done, added a new customer, um, ironed out the kinks in how it worked, and that is now our kind of core business. And we have today over close to $2 billion in AUM, sitting at about 1.9 billion today.
That's amazing. That's amazing. Godspeed to you for sticking out the bear market, because I saw so many teams just pack it up and quit when things got tough. So
It was
that's
it was tough during the bear market. We had to lay off 40% of the staff after FTX. Everybody who remained had to take a pay cut. Morale was lower, and but I think, to our credit, what we managed to do as a team was just keep our heads down, work out what was in our control, and then just keep showing up. Just keep showing up every day, and and believe that we could get back in the game, and that we had something that people would want to buy. And so you have to kind of remain stubbornly optimistic, I would say.
Right, right. So now I know that, like, you've described previously, Maple Finance as a bridge between TradFi and DeFi, and you mentioned that early on the history, you're still kind of futzing about trying to find a product market fit, doing loans to degens. At what point did
Yeah.
it kind of crystallize that this was going to be the mission? Was this before the kind of FTX collapse, when you got into the TradFi to DeFi bridge, or was that more recent?
I think we always kind of viewed ourselves as a little bit of a bridge, back in 2021, 2022. I think we were just kind of early in our estimate of when TradFi would start to come in. I think that was kind of set back by a couple of years with FTX. But it was always a way that we described ourselves. But the way that the platform worked at that point in time was that it was infrastructure for other people to come and underwrite loans and run lending pools. And they were, that role, the delegate, the manager of the lending pool, was really for third parties to do. And what we and so we envisaged that over time tradfi players would come in and fulfill that role. And I think over we've always had this idea that we are kind of a bridge, and I think that comes from the fact that a lot of us have previous traditional finance experience. Myself in banking, we have others who worked at credit funds or in trading desks. And so we've always had that aspiration, because I think to really grow, all the big balance sheets are kind of at those institutions. So you have to offer something that you can sell them to get them to participate in DeFi. It's my view that we're kind of we're kind of capping out on the native amount of kind of dollars that can be contributed by retail DeFi, and that what we need to really grow and 10x from here is going to be those institutional balance sheets coming in. Now it's kind of more crystallized, and I would say, earlier this week we had the announcement with Cantor, and I would say this is kind of the early innings of actually fulfilling that promise of creating a bridge between TradFi and DeFi. They're a very well established, well respected TradFi name who's now engaging in size with the crypto industry and with partners like Maple as well as FalconX. So I'd say from here you're going to see an acceleration of that trend that we thought would begin in 2021 or 2022, but is now in 2025 really taking shape.
Yeah, I mean, that's basically the crux of my question, is what the conversation was like with traditional finance players over the course of the 5 years, 6 years now you've been doing this, right? Like, and yeah,
Was yeah.
what matters to traditional finance players in terms of getting on chain, and what has kind of changed lately? Is it purely regulatory? Is it seeing other players jump in and not wanting to be last? I mean, like, what motivates the traditional finance players here?
I think it's multi-pronged. I think the regulatory environment has definitely softened towards doing things on chain, and you've seen Sarah Atkins of the SEC as well as Commissioner Peirce making positive statements around the tokenization of assets and the value of doing things on chain, both from liquidity, transparency, speed. And so the first element is softening regulatory environment, or more permissive regulatory environment. I think the second thing is there is an element of FOMO. Once one of them does it, I think others, get a kind of sense of envy, and also it kind of bolsters their confidence. It's harder to get fired. It's easier to get fired if you're the first person who advocates for something, but if you're the third or fourth or fifth, and your peers are all doing it, then it's much harder to get fired. So I think that's an element. And then I think the fact that uh, probably the fact that Tether, the most profitable company in history per employee, is a crypto company, I think has also kind of helped grease the wheels, and proven that stable coins are kind of here to stay, and are indeed a very profitable market opportunity. So I think that's got some of these TradFi players kind of licking their lips. And and I think it's kind of a confluence of those three things, plus just, you know, there's now a kind of Lindy effect. These chains have now processed billions, hundreds of billions of dollars worth of transactions, and so you're much less likely to have some piece of critical infrastructure fail. And I think that was a turnoff before, and now as well, there's just more wallet infrastructure, so it's easier for these firms to actually engage with the blockchain. They don't have to have a ledger or a tracer. They can use institutional grade wallet solutions.
Yeah, it makes sense. The one question that I wonder about in terms of like institutional players coming on chain is that everything is public on chain, and that's like not always good for like some of the large institutional players whose like bread and butter is like keeping their secret sauce in house, right?
Yeah,
Like, how do
this is
they
true.
feel about this kind of like pseudo private environment where like the wallet addresses are of course like anonymous, but as long as they're linked to someone, which for the case of the large institutional players, like they're almost certainly going to
Mhm.
be, like then everything's in public. Like how are they okay with this?
Well, I think they don't love that. But I would say it kind of depends on the product. Like if you're Citadel or if you're a hedge fund, you don't necessarily want your trading positions to be doxed because that's part of your secret source. However, if you're a fund that's just distributing fund shares to people, or an asset manager who's just distributing shares in funds to people, like let's say Apollo, probably don't care as much, right? You're sending shares of tokenized versions of ACRED to people. I don't think you care as much about having that be fully anonymized because there's no secret source in that. The fund is just getting distributed to customers. What we've seen though is that there are kind of there's shielding solutions that are being built on Ethereum and on some of the public chains. And then the other alternative path that people are taking from an innovation perspective is just to build semi-private chains or private chains. I've seen a number of these being kind of pitched recently. So you have Alio, Canton. There's three or four others that are kind of in stealth that I've seen at the moment, and they're all being pitched partly on this idea of institutions do not want to be doxxed, and therefore they're going to use this blockchain for that exact reason. So you could also go in that direction.
Interesting. That's so funny because the like private nature of blockchains from like 2010 to 2015 was like used to say like, oh, it's just for drug dealers and like black market. Now it's like we're going back to
Yeah.
privacy in a way to like get institutions on chain.
What's worth noting, the biggest mixers out there are the centralized exchanges, right? When you send money to a Coinbase or a Binance wallet, it then becomes impossible to trace what's happened to it. And so I think there's always going to be a desire for both. You will want the blockchain for provenance purposes, and that's great for things like invoice finance and tracing ownership, and then you'll also want the blockchain. You'll also want privacy options, particularly if you're a hedge fund or high frequency trader. And so I think there's room for both. I've seen one team that's building effectively dark pools on DeFi, and I think there's going to be a ton of buyers for that type of thing. Horses for
Yeah.
courses, so to speak.
Yeah, like I definitely see where institutional players like talking with you about solutions because you have a amazingly conversant grasp of all the technology and all the trends. Let's dive into like Maple specific products. So
Yeah,
I'm
sure.
smooth brained, so like I probably get this wrong, but let me like try and like explain it as best I can. So my understanding is that Maple provides like a peer to pool lending model where you have pool delegates do the credit underwriting. And you talked a lot about risk and how like assuage risk management concerns. So like how do you like guarantee at Maple that these delegates are maintaining really high standards, and like what protections are you putting in place for lenders that are interested in using Maple?
Good questions. I would say what you've accurately described was kind of V1 of how things worked, and what we
Okay.
have now is effectively we are the sole delegate on the platform. So
Okay.
we used to have third parties. We found that we had less control than we would have liked over how things were
Hmm.
going, and we also wore more reputational risk of how delegates performed. And then also we're paying away a lot of economics in terms of the fees coming through the protocol to delegates. So we brought that in house. It allowed us to speed up the launch of new products, and that's kind of the model that we're sticking to today. So Maple is the delegate, and and the way that the product works today is we run multiple strategies. So each now, instead of you having different delegates running different strategies, you have us running different strategies through different lending pools. So we have from the most conservative to the most risk on or high yield. We have blue chip. We have blue chip, which is just BTC and ETH backed loans available to accredited investors, and we lend to institutions. They post BTC and ETH collateral, and so it's relatively conservative. Then we have the high yield pool. This accepts Solana, XRP, some other assets, but mostly BTC, ETH, Solana, and XRP. So the kind of the large caps. So you get a higher yield because it takes a wider set of collateral. So you're getting paid more because you're taking on a bit more risk than just doing BTC and ETH. Then we have Syrup USDC. Now we're getting into the kind of the permissionless side of how the product works. And the only difference with this product is that it's available outside of the US to retail and protocol users, and it will lend against all of the above collateral types that I mentioned. But the kicker, or the nice thing about it, is that it's integrated through DeFi. So once you Garrett deposit USDC to it, you can take your LP token, you can put it in Morpho and borrow against it, you can put it in Pendle and fix the interest rate that you're getting, or you can immediately exit the position by selling it on a secondary market back for USDC instead of waiting, instead of having to wait to redeem your funds. So it's much more DeFi integrated. It's been growing a lot because of the partnerships that we have, and it's also being used by large sort of stablecoin issuers like Sky and the Sky Spark ecosystem. The third product that I'll just touch on is BTC Yield. So we do this in partnership with CoreDAO. The product is, you give us BTC, we stake it in the Core ecosystem. We dual stake it with Core tokens, but we manage the hedging and the risk management around that Core token position, and then we sell the rewards back to BTC. So for you as a customer, what it looks like is you gave us BTC. You didn't have to sell your BTC. It wasn't a disposal of BTC. So there's no taxable event there. Your BTC sits in a custodian. So it's, you have the protection of a custody account. And then there's no slashing risk. And then finally, and this is probably the most important part, you receive your yield back in BTC. You don't receive it in points, altcoins. There's no 1 year lockup to it, and that has been extremely popular for people who are early Bitcoin holders. So we have a lot of high net worths in there. And what we're going to do with that product, which we're really excited about for the rest of the year, is we're going to launch an LST BTC token. So this will then be a yield-bearing BTC token available across DeFi, can be used as collateral, can be posted, ideally be able to be posted to to centralized exchange accounts, and can trade on secondary markets as well. So that's where we want to take it, is kind of the whole Steve model of pushing out this yield-bearing token across multiple chains. So I'll pause there. I know that was kind of a lot to digest.
Oh no, it sounds brilliant, because that's one of the things that got me into DeFi was I had like stacks of Bitcoin sitting around, and I was like, what can I do with this? Like, I want to earn yield, and like I fell into the rabbit hole.
Up until this point, there's really been like no good yield products on BTC.
It's been horrible. It's been absolutely horrible. And like at a certain point, like I was kind of like, why am I taking all this extra risk to earn like 1% yield on Bitcoin or whatever?
Yeah.
It just was like,
and for a long time, the only yield you can get was from lending uncollateralized, and you're getting 1 to 2%. I heard that in the peak of 2021, 2022 cycle, to lend BTC unsecured, you're only getting 12 basis points, like 0.12. I mean, that's almost not worth it.
No.
In terms of the administrative costs. But this product has been printing about 5% annualized over the last couple of months. We think that when it goes to LST BTC, it probably still achieves somewhere between like 3 to 5%, or 3 to 6%. So it'll still be very competitive, but on a risk-adjusted yield basis, it's pretty good because it's just being staked. We're not out there lending it unsecured, and the time to redeem is actually going to be pretty quick.
That sounds almost like too good to be true.
Yeah, we'll see.
Did I lose you? Or did I lose myself?
No. I've got you back. I heard it's almost too good to be true. Yeah, I'm always kind of careful of over promising. I think whenever we talk to people, we try and make clear the risks that are involved. So we have to manage a position of core tokens alongside the BTC for dual staking, and so that's where the element of risk that's involved is. But we use hedging, we use OTC counterparties to hedge that risk. And we think that it's kind of contained at a manageable level. But we certainly don't go out and tell people, hey, there's no risk involved. These are, this is a magical APY that you can earn with no risk involved. I think we saw how those practices turned out last cycle, and we always want people to go in eyes wide open into what can go wrong with any product, because there is no free lunch, right? That's kind of like the core tenet of finance.
Yeah. Yeah, I mean, everything you're saying is making me think of my experiences with Bancor, which was promising
No
no
impermanent
impermanent
loss.
loss, and then they had
And
nothing but.
you know, and that was supposedly going to come from just giving Bancor tokens to people.
So anyway, yeah, I'm still annoyed by that one. So I appreciate you being like very upfront and transparent with people about it. But like, it sounds great. So as a U.S. citizen, like, am I allowed to use it, or am I prohibited?
Right now you can use it. So you just have to pass an accredited investor check at the moment on that one. Later on, we're hoping to make it more widely available, but for now, you know, um, there's always scaling issues with a new product, and so we have to limit it to accredited investors. Uh, but uh, but with LST BTC,
The way Bitcoin's going up,
everyone,
even
anyone who's got
oh,
one
the way
is going to be considered an accredited investor pretty soon. Also, the way inflation is going, you know, like the 200K annual salary is not gonna be worth that much. Maybe it can get you a few dozen eggs at the grocery store in the next 5 years.
Yeah, so that sounds really cool. Very excited to see that launch, and I think that the idea of the like the token that could be used throughout
That's what we're
DeFi is
most excited
especially
about
like
with it,
just it just
because
seems
it
so
opens up a
powerful.
ton of partnership opportunities. We can get it onto Solana, Avalanche, Base. So we really want to proliferate it and push it out across all of these chains, and then we want to see it used as both collateral and DeFi. And I think one of the examples I look towards is, I think the Athena team did a fantastic job of getting USDE onto exchanges, whether it's Deribit, Bybit, and I'd like to see LST BTC available on major centralized exchanges as well, so that we're not just spread across DeFi, but we also have a footprint in CeFi. And I think I always look at the way we've tried to position our product suite is, what will institutions be interested in? Whenever I talk with Galaxy or Coinbase or any of these large, institutional shops, they're always telling me that the first thing the institutions do when they enter the space is just buy Bitcoin. So I think, okay, well, what are they going to do after they've bought Bitcoin? They might look to borrow against it or lend against it, or they might look to get a yield on it. And so you can see that's our product suite. We have, you know, you can borrow against your Bitcoin with us. You can lend against Bitcoin with us. You can also get a yield on your Bitcoin through the core staking strategy. And so we really want to be. That's kind of where we want to be. That's where we think the tidal wave of capital is going to come.
Yeah, are you gonna get Sailor? Is
I'd
Michael
love to get
Saylor and
Sailor.
Strategy gonna be taking their stack of Bitcoin?
I'd love to get Sailor.
All right, Sailor, if you're listening,
I feel like Strategy's stack of Bitcoin would potentially break the strategy, the staking strategy at this stage. 500 and what is it? 555,000. I think he has at this point. But um, in all seriousness, I do think with the proliferation of uh, public company Bitcoin treasuries, you're increasingly going to see competition between them. And how will they compete? With having holding a Bitcoin treasury is going to become relatively undifferentiated in future, and so what they'll have to look to do is, they can be competitive or differentiated on their financing solutions. I think one of the things that Saylor has done, which is genius, is, you know, he's managed to monetize every portion of his capital stack. So he has common equity, pref equity, convertible bonds, or convertible notes. He also had, a couple of years ago, and a lot of people don't remember this, but he actually had a line of credit from, I think it was Silvergate, collateralized by Bitcoin. And so we could be in partnering with these Bitcoin treasury companies, offering them a line of credit, which allows them to opportunistically buy the dips. But the other thing that we can offer them is, of course, Bitcoin yield. And so over time, as more of them, you know, as there are more of these companies holding Bitcoin treasuries, the other way that they can compete is, of course, what they do with their Bitcoin. And one of those things will be, how do they generate a yield on it? They can do covered call selling strategies. They can do statistical arbitrage and trade around the Bitcoin, or they could do a staking strategy like what we have on offer. And so that would, you know, that'll be a massive strategic priority for us, is establishing those partnerships in time.
Got it. Got it. So I hope everyone who's listening is paying attention. If you're one of the hundreds of people listening to this live on X or YouTube, take a second to retweet, share this. Get your grandma and grandpa listening in. They want to hear this. Let's get into as many people's ears as possible, so that Michael Saylor will actually be in the crossfire, and he'll listen to this and he'll be like, yeah, I should do that. I should do that, because that'd be a lot of fun. I'm curious to you talked about if Sailor entered in size, it would kind of break your strategy for generating yield.
At this point,
Could you talk a bit more? Right. At this point, I'm sure you'd solve it if he got in. You'd hustle and come up with some solutions to accommodate
we'd
him.
definitely try and hustle to accommodate Sailor. He's doing God's work for the space. But the reason I say that is, let's look at how the strategy works. So we stake Bitcoin and Core tokens to validate the Core network. Core is a couple of years old, and so they are growing out their ecosystem. But the yield comes from us validating the network, receiving Core token rewards, and then selling them back to Bitcoin. And as part of the staking setup, we have to go and buy a bunch of Core tokens to do that. So the first element, where over time, as the Core ecosystem grows in size and the Core token also grows in market cap, it can accommodate larger checks coming in. But let's look at Sailor has, let's say Sailor, the ratio of Bitcoin dollar value to Core token value that you need to dual stake is about 10 to 15%. So for every $1 million of Bitcoin that you stake, you need to have about $100,000 to $150,000 worth of Core tokens. Now, Sailor has something like $50 billion worth of Bitcoin. So let's just use that round number. So then I need to go and buy somewhere between $5 and $7.5 billion worth of Core tokens to stake. Now that exceeds the entire market cap of the Core token at the moment, and so it would it would push the price up a lot, but it's going to be next to impossible to buy that much at this stage. That's why I say the strategy has to grow to be able to accommodate that kind of size, and it will be gradual. Like maybe you can take in, clips of 1,000, 5,000, 10,000 at a time, but it'll be a little while before we scale up to be able to take 50,000 Bitcoin. But that will be the end goal.
Got it. You'll get there. You'll get there. So, all right, cool. And it's not just Bitcoin that is the assets you've been considering. Like I saw earlier this year, you were looking at XRP. So I'm curious, how do you that? Like, what assets are you looking at? What's the criteria, but through which you're looking at that? Oh, there we are on the right. By the way, 250 people watching.
Love
Come
it.
on, retweet, get that up to
Love
1,000.
So this is the core. This is one of the core questions from a risk management perspective for us, right? Because we lend against collateral, so the collateral is kind of the main fulcrum point for where risk, where risk can show up. And so we have Bitcoin, ETH, Solana, XRP. We've done some others, like we've done Pendle PT tokens against SUSDE, so the Athena the staked version of the Athena stablecoin. Increasingly as we're scaling. So before, when we started doing some of those types of loans, we were like 100, 200 million in size. Now we have 1.9 billion AUM. So we actually have to kind of evolve our thinking and look at really only the tokens that we can do in size, loans against in size. Now, I would happily lend, $100 million against XRP, because XRP is a top 5 coin. It trades billions of dollars a day, and there's tremendous amount of liquidity on all exchanges. So that's how I kind of think about it: is what's the liquidity, what's the maximum daily drawdown, what's the maximum weekly drawdown in these tokens, and if I stake them, because we can do that with collateral, is we can stake it and then we achieve a yield on the collateral, which contributes to the all-in return on the loan. If I can stake it, how long does it take to unbond? Because that impacts how much I'd be able to sell if I needed to exit the position in a hurry. And so we run every piece of new collateral that we consider through a new collateral review that takes about 2 weeks. So our smart contract teams will audit it. We'll look at where it's supported in custody and in wallets, and then we'll look at which OTC desks will trade it, so that we know who to go to if things were to go wrong. And then in negotiation with our borrower, we set an initial loan to value or collateral level. We set a margin call level where they've got to top up or pay down, and then we set a liquidation level. And that at that point, we're not asking questions. We're not asking them for more collateral. We're just selling it. And so if you look, XRP, Sol, these assets trade billions of dollars a day. You can get extremely comfortable lending against them in size, and because you're going to have no trouble exiting. All the major OTC desks trade it. All the exchanges hold it or support it, and all the major wallets support them.
Makes sense. Yeah,
So we want to be doing. The answer
I'm
is we
trying
want
to
to be
I'm
doing
trying to
more
think
of all
through
of those types of loans. So if and the loan sizes that we're increasingly looking at, we used to do $1 and $2 million loans. Now we're increasingly targeting 25, 50, $75 million loans to folks, because we just need to scale. From a labor perspective, it's kind of not worth. It's not economic for us to have somebody spend days underwriting a $1 million or $2 million loan. We need to kind of hit scale and do 25, 50, $75 million loans.
Of course, of course. Yeah, I'm just marveling at the timing in my brain because you were approving XRP in January, and I think it was only a couple. Is after that like all the
Yeah.
regulatory cases against them got dismissed.
Yeah, we initially saw most interest from high net worths borrowing against XRP. The XRP army was very strong, and now now we're seeing more institutional holders looking to borrow against it. You've seen a lot of tailwinds behind XRP. They've had the RLUSD stablecoin that they're issuing. They have the Hidden Road acquisition. They have XRP ETFs. XRP now trades on CME futures as well. So I think there's a ton of tailwinds for institutional adoption of XRP.
Yeah, absolutely. Absolutely. So amazing timing on that one.
Mm.
So in April, just a month ago or so, you did your big conversion of MPL to syrup. Could you talk about that process and what you learned in the rationale for going through this big tokenomics overhaul?
Well, the first thing I'll say is I don't recommend going through a token migration to anyone who can avoid it. So why do we do it? We initially, MPL was fixed supply. Fixed supply is a huge mistake for anyone starting out contemplating launching a token. It really locks you in and gives you very little freedom when it comes to surviving bear markets and capital raising activity and M&A activity if you want to do it. So we had a fixed supply in 2023 during the depths of the bear market. We had to do a raise that it was at a more dilutive level, but that would have exhausted the tokens in their treasury, and so we therefore had to mint more tokens to continue. And so we had a governance forum vote on it, and it was approved. And as part of it, there was a one-time mint of 10% of new tokens, as well as 5% inflation for a period of 3 years, so that's not too dilutive. And then a 100-to-1 token split, so that it became, the token became kind of more accessible because it was going to be, because it was going to be kind of rebased to under $1. And so I think ultimately the community got behind it, but initially there was a lot of frustration because it got delisted from, as part of the migration, it got kind of delisted from some exchanges, and then this year we've seen it supported on more exchanges, and we closed out the migration, which I think was beneficial to the community in reducing uncertainty. So we have one token, Syrup, which governs the entirety of the network. It can be staked, and then there is a buyback program. And so currently we use about 20% of protocol revenues to buy back the token, and that then goes to people who are staking Syrup, participating in governance, and so it rewards them for staking and for participating in governance. And so we like to keep things simple. So we've no longer support MPL. We gave people 6 months to complete the migration, put out numerous blasts and emails about it. Now we're all kind of just focused on the Syrup token. And the other thing I'd say is, unlike some other protocols, there's no equity in the protocol. So there's just the Syrup token. There's no entity which raised equity, and therefore there's no conflicting interests from token holders and people participating in the network. Everyone is just aligned around syrup, and so I think that's positive, and and just prevents kind of conflicts of interest that we've seen at some of these other protocols. And so the goal from here is to continue to kind of grow things. As we get larger, the community can have the opportunity to vote for a larger percentage of revenues going to buybacks. But currently, the protocol earns around 10 million. So at 20%, that'd be roughly a run rate of about $2 million a year going to buybacks, and that protocol revenue is up about 10x year on year.
Yeah, it makes sense. It makes sense to me. I mean, I haven't been following as closely, but like everything you say makes sense. So I don't know if like there are still people that are saying it's controversial or whatever. But seems above board from what well, like compared to the rug pulls I've seen in DeFi over the past like several years. That seems up and up.
Yeah, I mean, you can be transparent. There's, often when you do this, it's impossible to reach 100% of people, but you put in best efforts. You try and be transparent across the community forums, and then and social media as to what's going on, and I think that's part of kind of a reasonableness test. But I will say that the reception from the community has been positive so far overall for the migration. They like staking, they like the simplicity of just having the syrup token, and I think everyone is just aligned around this. And we also launched our rebrand recently to frame what we do as more like on-chain asset management. I think where we want to evolve to and the kind of the vision is, as we discussed earlier on in this call, Garrett, we want to be the kind of the bridge between TradFi and DeFi. And part of the inspiration that we look to in TradFi is folks like Ares and Apollo, where they are an asset manager who is focused on lending and credit, but they can have multiple strategies. And so if you look at our journey, initially we were infrastructure and a protocol, then we became a lender and a credit provider on chain, and now what we've evolved to is more of an asset manager because we added the Bitcoin yield strategy, which just comes from staking, so that doesn't involve lending, and that's that's where we see the puck going. I think when you look at the liquidity, the transparency that's available from doing asset management on chain, this is what gets folks like Bitwise and Cantor excited, and that's we think that we're at the start of a kind of multi-year trend there.
Yeah, I mean I definitely agree. But yeah, predicting the future is tough, right?
It is. All you can do is kind of predict probabilities and then choose the best path for yourself and kind of control what you can control. And sometimes your bet will pay off, sometimes it won't. But I think the key is to kind of lay some bets where there's asymmetric upside, or where you feel like you have an edge in either predicting or in executing on it. And that's kind of what we try to do. We think we have a particular edge in credit and in lending. We think that the fact that we do this on chain and have transparency around our loan book is an edge versus some of these CeFi lenders. And also, simultaneously, the fact that we're integrated with a bunch of custodians gives us a bit of an edge over some of the pure play DeFi lenders. They can't accept native BTC or Sol or XRP. They can only accept wrapped versions, and I think that's a problem for a lot of institutions. So we've kind of tried to set our product up to be perfect for institutions.
Yeah. So I really like that pitch that you're like the bridge from TradFi to DeFi. Now let's out. Like, do you think that this is a
Yeah.
one-way bridge? Like bridging to an L2, it takes too long to get back out, so it's like you're kind of stuck once you get to the L2. Like once the institutions move on chain, do you think they're ever going back to the traditional system, or do you think
No.
that they're just gonna like, yeah, they're just it's one-way bridge pretty much?
No, I think it's a one-way bridge, because I think it's kind of, it's the arrow of time, right? In the same way that people didn't just try out e-commerce and then stop using it all of a sudden.
Mhm.
Instead, what happened was that the traditional big box retailers had to then integrate it into their operations. And so now you can go on IKEA's website, you can order a bunch of furniture online, you can have it delivered, you can pick it up from the store, or you can go into the store and buy it. They didn't remain a pure in real life buying experience. And yeah, so that ended up being a kind of a one way arrow. And I think it'll be the same with institutions and participating uh, on chain. What would it take for them to go backwards? They'd have to start using stable coins and on-chain on-chain products, and then somehow find that the off-chain versions were faster, cheaper, more available, more accessible. I just don't see that happening. I'm a guy who does most of my banking in stable coins. I hate using the banking system. I find it cumbersome, slow. I got $100 invoice the other day, and I had to pay $25 wire fee to pay that. If everybody just accepted stablecoins, it would be a lot easier. We pay our legal fees in stablecoins, and it's 10x easier than going and using an off ramp and paying through one of our banking providers. And I think that's gonna catch on in institutional finance circles, and and so when it comes to like being the bridge, we see that there's going to be a ton of traffic coming on board over the next few years, but it kind of looks like an S curve. So it's very slow initially, takes a few years to get the first parties like a Cantor on board, and then the adoption will really escalate and it will go exponential. And I think that's coming in the next couple of years, right? You've got the stablecoin bill, you'll have the market structure bill, you have a bunch of banks considering launching their own stablecoins. Stripe bought a stablecoin on ramp and off ramp, and then we've also seen a number of brokerages talk about now offering crypto trading to their customers. So I think it happens slowly, and then all at once.
I mean, the speed with which it's advancing here is like mind blowing to me. Having been in the U.S. for the 4 years of like incredible regulatory like attack against crypto,
Yeah,
it's like amazing to see. Like I can't even believe it. But I guess like
but it
that's
shows we
the
were
the
kind of
night.
anti-fragile. Like the sector was anti-fragile, so it
Hundred
survived the
percent.
4 years, got stronger, arguably became more powerful from a lobbying perspective. You have Stand with Crypto and some of these other super PACs, and they raised a ton of lobbying dollars because of how brutal the last administration was to crypto, and how brutal the regulatory agencies were. And suddenly now they're causing politicians to lose their seats through pretty active guerrilla campaigning.
Yeah, I mean, it's been like I still though wake up with like fears that like, okay, what if there's just like an amazing dream and all of a sudden like I'm
Was it
gonna wake up and it's gonna so like but like let's war game this a little bit. Like because
Yeah.
I agree that like we're gonna see a lot more institutional adoption over the next few years, and in many cases it'll be tough to put the genie back in the bottle. But imagine in
Mhm.
2028 President Elizabeth Warren takes office and she campaigns on like destroying crypto. Like realistically,
Yeah.
like what damage could she actually do at that point?
Well, I think
Like,
at that
she's not
point that
going to be able to, like it'd be too
I think
entrenched, right? It'd be like campaigning against the internet at a certain point.
yeah,
Sorry,
ideally,
like
I mean, ideally, that's what we use the next 4 years for, is to get the technology and ownership of crypto so entrenched that it does indeed start to look like just campaigning against the internet or campaigning against smartphones. And I think the key drivers are going to be the number of Americans who own crypto is going to increase exponentially over the next couple of years. So you've seen Robinhood offering crypto, other exchanges, and brokerage firms like Charles Schwab and Interactive Brokers are going to offer crypto to their customers, and then stablecoins. Once a bank issues the first stablecoin, it's kind of all over, right? Like, because they'll have all of their, it's going to be then intertwined within the banking system, and customers will be used to trading in it, or spending it, and kind of accepting payment in it. So I think that's kind of the key thing, uh, as well. The normative rulemaking that regulatory agencies like the SEC do. Um, if that kind of continues, and continues to be quite accommodating and pro innovation, then once a bunch of institutions have kind of set up their own crypto teams and product lines, it becomes next to impossible to kind of walk back and say, actually, all this stuff that you've been doing for the last 4 years is now illegal, right? Like, the
right.
the amount of wealth that would be lost by Americans uh, from that would make it a total impossibility from anyone who wanted to seek elected office.
That's my sense. So it's almost like this crazy thing where we all like fought and won, and it's like sunshine and unicorns for the rest of the way. But maybe it is that easy.
I can
I don't
I
know
can
though.
I don't want to jinx it. And so I think, famous last words saying it's going to be sunshine and rainbows all the way. No doubt something will come up. I saw this morning they were talking about quantum computers and how they're going to crack Bitcoin and make it all worthless
That's
for us. But I think, you know, I think we're over the worst of what we've seen from a kind of regulatory, uh, you know, regulation by enforcement attack vector, and so we're onto a whole new set of kind of dangers and hurdles to worry about.
Well, I do know there's a really big line of FUD against maple, which is like if you're going to BTC, there's a lot of carnivores and ketogenic diet, and how are they going to feel about a high fructose like
High
syrup?
fructose, high sucrose syrup.
Yeah.
What I would say is they should pay attention. There's actually a lot of carnivore influencers out there talk about eating raw honey and
Hmm.
fruit as kind of the only thing that they have aside from dry aged ribeye. So I'd say maybe
Okay.
maybe actually maple is compatible with the carnivore dieters out there among the Bitcoin community.
Okay. Okay. That's good. That's good. I'm glad that you're keeping up on that. um, no, no, it's super cool. Obviously predictions are tough, especially about the future. But like, if we do get in this like new world where crypto gets embraced, and like, we do see trillions of dollars of inflows into crypto, like 5 years out from now, where could Maple be?
So the outer bound of our market opportunity at the moment is I kind of look at two things. One, what is the market cap of stablecoins at the moment? And so we're at, call it roughly 250 billion. And that we lend in stablecoins. So that kind of sets the outer bound of how much we can lend. And so I want to see that increase. And I think stablecoin bill will help push that up, as well as the entry of other new Web two and traditional Web two finance companies and traditional banking providers offering stablecoins will help push that up. But I want to see that get to 1 or 2 trillion. So I actually think within the next 12 months from now, we could see $1 trillion or somewhere between 750 billion and a trillion in terms of stablecoin issuance. I think that'll really hockey stick. And then the other thing I look at is for our business or what we're trying to do, loans against Bitcoin. I think this can be like the agency-backed mortgage. So it's a very investable product for insurance companies and other fixed income asset managers because it's over collateralized by an asset that trades 50 billion plus a day, trades 24/7 around the world. You can do a liquidation at 2 a.m. on a Sunday if you want, and it's the loans are often very short dated, so open term, but you can recall them within 30 days. I think that's a much better product. Like, it's a much better yield pickup versus money market funds. So I could see a lot of traditional asset managers investing into that type of product if we can find a good wrapper for it, whether this is structured notes, funds, ETFs, CTPs. But I'm really excited about that over the next 5 years. I think that's a huge opportunity. I also just look at the size of Bitcoin backed lending as an opportunity. So, Bitcoin is over 2 trillion market cap. If even 10% of people want to borrow against Bitcoin, then that's 200 million. And if you're doing loans at a 70% LTV, then you're talking, 100 and call that what, 140 billion of outstanding loans. I would say today there's less than 15 billion in kind of outstanding lending, particularly among the CFI players. And so you're talking a 10x, 10x potential growth in addressable market there. So I'm really excited about the growth in those three things. Stablecoins enlarge our addressable market. Institutions will pick up this short-term investable product, and and the market cap of Bitcoin is going to continue to grow because we saw that Elon couldn't contain the government spending. So you're just going to see continued debasement to infinity, and that's going to push up the price of Bitcoin, really for the next 20 plus years. I see.
Yeah, it's going to be a silly season, I think. So excited to be here for it. I'm excited we're going to get to watch it roll in together. I hope we do see some syrup USDC flowing onto Curve. I don't know like what your strategies are, but
Well,
like
we'd
as
love
someone who
that.
barely leaves.
Syrup USDC would be a perfect fit for a stablecoin pool on Curve, matched against USDC, USDT, maybe USDE. But yeah, we would love to see that integrated there.
But I know that you have a hard stop. You got to get to the all team meeting soon. So you definitely want to take a moment to thank you for your time. A moment to shout out again for those of you just joining us, AIOZ, who purchased the Squid Pass, available at leviathannews.xyz. Go there, subscribe to all of our social links, tell all your friends. Sid, before you depart, where should people find you? And any parting words of wisdom?
You can find me on X. My handle's down the bottom, so at Syrup Sid. You can follow Maple at Maple Finance, one word, and then our website is maple.finance, which just got a nice new revamp. So please do go and check it out. And otherwise, keep an eye out. The next big things for us are getting Syrup USDC cross chain, and keep an eye out for our liquid staking Bitcoin token.
Right on, right on. We'll be doing that. All right, friends. It is May 30th. Another successful Llama party in the books. Squids, we will catch you on the next tide.
Awesome. Thanks for having me.